Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing, and I'll share a buy price for Arista Networks, ticker ANET. This one came in by request down in the comments section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I will get the ticker on the whiteboard behind me, and eventually I will make a video for you. If it's a stock that's in the S&P 500 like Arista, I post those on YouTube for free. The rest are over on Patreon at the $5 tier per month level. There is also a free tier on Patreon where I post all the same videos plus a few more from YouTube. So if you don't want to rely on the old YouTube algorithm to get your analysis, for me, that is a good place to go. As always, this is not individual investing advice. This is just how I analyze stocks. So let's just get right into Arista. This is all so on the fast graph here, we have about, almost 9 years worth of data here since 2015. Most of those years have seen earnings rise significantly with the exception of 2020, which we know we had COVID, so that's kind of its own little category there. But for the most part, earnings growth has been super duper strong. If I were just going to use the historical earnings growth that we have here, I would use the maximum assumption, which is a 20% growth rate for me, but that goes 10 years into the future when I try to do these valuations. So if we just use the historical data that we have, that is what the earnings growth rate would be. But I'm going to use a more conservative earnings growth rate for a couple reasons. The first reason is that we don't have any real normal recession data here. So we really don't know how cyclical this business will ultimately be. So it's possible if we have a recession, a significant recession, maybe earnings decline for a couple years, and maybe they take a couple years to recover. In that case, that earnings growth rate will be significantly lower because when I calculate my earnings growth rates, I take into account these years in which earnings are down. It's more of like a cumulative type of, the idea is if you own the business, how much earnings could you collect over that time and what sort of growth rate would that calculate to, basically. So that's one reason why I would choose a more conservative earnings growth rate. But the other reason is when I look at analyst estimates, they're looking at finishing out this year with 18% growth and then the next couple of years like 14% earnings growth. I'm using a 15% earnings growth rate, so I'm already going to be a little higher than what analysts expect, and I'm usually always trying to be more conservative unless I know we're in a down period and everybody's negative. So right now everybody's not negative and analysts are still saying like 14% a year for the next couple of years, and I want something I can project out like 10 years. So it creates a situation where I just have to use some judgment. 15% is where I come down at. I think that's a fair balance of balancing what they've done historically, which has been fantastic, with the potential for a downturn at some point during the next 10 years to occur, and then also with analyst expectations. So that's kind of how I arrived at that. I'll share the buy price for Arista here in just a moment, but I do want to say I remembered this one because I barely missed buying it back in 2022. I went back to one of my old spreadsheets to see what my buy price was because I remembered it, and it was 103, and so they actually fell below that to 90. But because I didn't have, and granted this is like 2 years even before, I really didn't have very much historical data on these, so I added a momentum factor as well. So I wanted there to be positive momentum and to be below that 103 price. And basically what happened was they very briefly dipped below the price, but by the time they gained positive momentum, they were well above my buy price. So it just kind of like sneaked past me a little bit, which happens sometimes. But there are definitely times when my momentum factor, when I use it, has saved me lots and lots of money. So it's one of those things where there are opportunity costs sometimes. Now I think it's overpriced, which we'll see here. But this growth here, I think was all fair. Like this was all pretty solid because they had the earnings growth to back it up. So this price rise from the bottom, I don't know, maybe the first 100% or so. I'm not sure. Let's look. Let's call it $100 down there. Yeah, I think that rise from 100 to 200 it's probably legitimate. They had the earnings to back all that up. And then the rise this past year or so has just been kind of over enthusiasm probably. But we'll get into that when I look at the numbers. So it's kind of a mix of legitimate growth that deserves probably some sort of like premium valuation with, the market just being kind of extra exuberant right now. Okay, so here's my spreadsheet. Decided to pop in here finally. So the way I do this is I take, basically, like I described earlier, I want to know how much in earnings per share basically I could collect over 10 years if I was the owner of the business, okay? So what I do is I take the earnings yield and I do adjust for the debt so they actually have net cash. And this is worth pointing out because it doesn't always happen. And I didn't update this just a second ago, so this was updated a little earlier, like last quarter probably. But the real stock price is 404, but I'm treating actually like it's a little cheaper at 380 because of that net cash. So that produces an earnings yield. I think the PE was like 50 or something. That produces an earnings yield of 2.16. So the earnings yield is the PE ratio inverted. And then I did account for some of their cash there too. So it's actually a little higher than it would be probably if you just did the stock price and earnings straight up. So the way to think about this is if I bought the business for $100, it would actually earn $2.16 using this year's earnings. I pull forward the earnings from whatever year we're in. We're close to the end, so I'm really only pulling forward one quarter. When we get into January or February, I'll start looking forward into 2025. And usually, we just saw on the fast graph, earnings are expected to be 14% higher. So I would get more aggressive, I guess, or more optimistic, pulling numbers forward more quickly, basically, than I am right now. But really, an earnings yield is pretty low. I mean, it's about 50 basically is the PE because you only earn $2 for every $100 that you invest per year. And then I want to know if I just collected this along with the earnings growth of 15%, how much money I could collect on my $100 over 10 years. So I've been asked to move my head down so people can read. These are just how many years have gone by up here in my spreadsheet. You can take it out farther than 10 years, but for this particular analysis, I cut mine off at 10 years. Now, if people do like a discount cash flow analysis, which is pretty similar to this in some ways, a lot of times after a certain number of years, they'll have like a terminal rate of growth that they just extrapolate out forever. I don't do that because businesses don't usually last forever. I want to know over the course of 10 years, how much money could I earn? And so how many years you choose to forecast out is really important. If a company has a faster growth rate, the more you forecast out into the future, the more you can justify the current valuation. So it does matter like how far out, but my standard is usually like 10 years for this type of analysis. It makes it easier to compare like bond yields and things like that, I think too. And it's just more realistic. It's more conservative. Because you don't even know whether the business will be around after that. But the main thing is like if you forecast out 10 years and you have a rational investor who's just like you, who's going to buy the stock in 10 years, well, they have to forecast out another 10 years. So my way of thinking of it is that if you forecast out 10 years and you're expecting somebody else to buy the company from you at a higher price or at whatever value it's at, and they're using the same method as you, well, they need to forecast out 10 years too. So you need to really double the range that you're using. And 20 years is a very long time to try to predict what will happen with a business. So there is like a philosophical underpinning to the reason that I do it this way, and it does make things more conservative. It makes things much more conservative with fast-growing businesses because the longer you forecast out something like 20% growth, you can justify almost any PE ratio, basically, or earnings yield. So a little extra information I don't always share in this analysis, but that's why you should watch all these analyses. Just because it's on a particular stock you might not care about, sometimes I'll go on a tangent and I'll point out something interesting that I think the stock offers. So I forgot to say actually how much we would earn. Let me $150. We start with 100, we end with 150 after 10 years. So that works out to a CAGR of about 4.17%. That's pretty low. That's actually right where the 10-year bond yield is. But the advantage of investing in Arista versus the 10-year treasury bond is that if there is inflation, these guys should be able to pass it on. And this number would go higher, even though we don't know how much inflation there would be. They would be able to pass that cost on. So the real return might be similar to with 2% inflation, whatever inflation we've had during this time, 2.5 to 3. So you can kind of, it's a hedge against inflation if you own a good business, assuming the business keeps doing well. The bond is more of a hedge against downturn, losing money in your business, right, compared to the business. But you can compare the rates of potential earnings, and they're basically the same. So knowing that information can help you make decisions about what do I think the bigger risk is? Inflation? If inflation is the bigger risk and you really had to choose between one or the other, you would choose Arista. If an economic downturn was the risk, then you would choose the bond, right? So it's good to know like the cost benefit of these things. This is one of the reasons why I only invest in high quality businesses, because the core value proposition of owning the stock of a business is that they're high enough quality they can pass unknown inflation on. We don't have to know ahead of time what the inflation rate is. We just have to know the business people need the services of that business and will have to pay whatever the inflation comes along. But this is very low. So 5% is usually my threshold here for when I would consider selling or trimming a stock. So judging by what I've done with other businesses kind of like this, Netflix is a good example that I bought during 2022 when it was cheap, just like Arista was. AMD is kind of another one, even though it's more cyclical. Remember, we don't know the real cyclicality of Arista yet. With those two, I sold half my positions when they got overvalued, and I just held the other half for the larger secular growth trend that's probably there, or their dominance in the business, or whatever you want to call it. So if I had bought this in 2022, I'd probably sell half of it now, just because there's risks that we don't know. We do know it's expensively priced. And then the other half, I would say, look, I got a quality business. I don't really know the whole future. I'm taking some of the risk off the table, but the rest I'm just going to let go until there's some problem with the business, right? So strategically, I don't like actually making those calls. I'm more of like a buy, sell, hold type of neutral, pretty much type of a person. But we are in a situation where a lot of secular growth businesses have a lot of built-in cyclicality, or are very expensive. And Arista probably is some mix of that, with a 50 PE and unknown cyclicality, but with good secular growth. It's a good mix. So I would say, it is one of those cases where it probably makes sense if you bought this one a couple years ago it's expensive enough I would feel comfortable taking profits, but I'd probably only sell half. Now to come in to buy it, I'm going to get the normal critiques where my buy prices are too low. But you're looking at 55 to 65% lower than where we are now. If we have a recession, 140 is what I'd be looking at to buy. If it's just kind of a downturn, one like 2022 was, like 176 would be good. I might add that momentum factor again, depending on how things are shaking up at the time. We have a little bit more history with these guys now, even though we don't have a recession. So, it would be a judgment call. But yeah, 55 to 65% lower to get a good deal. And it has, in 2022, it hit my buy price. So it's not as though, and they were way lower than not way lower. It was at 103. So, but it was lower than where it is now. And that was only 2 years ago. So the critique that I always get is my buy prices are too low. I'll never buy anything. So I have a new service on Patreon just for these folks that think I don't buy anything, where I have a stock idea each week. So it kind of forces me to just pick whatever the best deal is in the market at the time. And rather than holding out and waiting for the very best deals, that I can find, which is what I do with my broader portfolio and in the full Cyclical Investors Club service on Seeking Alpha. So any of those tiers on Patreon you join that you pay something for, you'll also get a big discount if you ever decide to join the full Cyclical Investors Club service. But for those folks who think, I've bought 160 plus stocks since 2019 and 23 in the past 12 months. So I do buy things, but they don't always get shared publicly. And some of my strategies aren't available publicly. But in that weekly Patreon tier where I have an idea each week, all of the strategies are on the table and available. And if nothing is a buy, I will find just whatever the best thing is I can buy. So if that's your big critique against me, I have just the tier for you over on Patreon. And you can, check it out. All right. So I think that's all there really is to say. I'm not an expert on their business, so this is just like a structural analysis based on historical earnings and then, being able to see kind of how things have behaved. If you found it useful, if you, like these videos, hit the like button, hit the subscribe button. If you have a request, put it down in the comment section, and I'll see everybody later. Bye.